You've probably had that niggling thought in the back of your head. The cash that you're putting into your investment of choice, you thought you were pretty switched on about doing it, especially so early on in your life. But is it truly worth all the income tax you pay on that money? Or on the other hand, you might be old beyond your years and you've taken the bold move of increasing your pension contributions through work above the minimum. Well, in this video, I'm going to lay out all the information that you need to be aware of so you can review what you're currently doing and then actually reflect on those choices and think if you need to make any changes going forward. I'd love to say that it's easily one over the other and I could just simply roll the credits right now, but there's actually a hell of a lot to take into consideration and it's highly probable that you're not aware of all of it, so stay tuned. To clarify, I'm talking about your workplace pension, not your state pension. If I'm completely honest, I don't think state pensions will exist by the time I get there, or at the very least it'll be means tested. When I say means tested, I mean that you probably need to live pretty much on the poverty line to be eligible for one. So if you're under 50, I would consider that as a strong possibility. So here goes. Should you be overpaying into your pension or should you be investing? Let's get into it. Let's clarify by what we mean before we get started, just to make sure we're on the same page. When we say overpaying into your pension, we're talking about contributing above the minimum required by law. If you work in the UK, this means that once you hit the grand old age of 22, then the minimum that needs to be paid into your pension needs to be 8%. 3% from your employer, so that's 3% above your salary. It's not coming out of your own pocket, so don't worry, that's 3% extra they put in, but then you need to contribute 5%. If you were to over-contribute, this would mean you're paying more than your 5%. Remember though, this is the minimum, and your employer could offer more than the standard. The two companies that I've worked for so far have done that, so it's definitely worth checking out. There might be an incentive for you to invest a larger percentage, which means they'll invest a larger percentage also. So anyway, do look into it. So whatever the amount you and your employer agree on, this amount goes to a pension provider. So one of the most famous examples of a pension provider out there would be Scottish Widows. You've probably seen the adverts on TV. They're actually owned by Lloyds Bank, which I had no idea of, so that's news to me. But there's various ones out there. They will invest this money on your behalf in order to grow your money as much as possible to ensure you have a big lump of cash when it comes around to retirement. So you might be thinking, why do we need a video on this topic? If you're actually investing through your pension and you're actually investing anyway, is there really much of a difference? Well, the reason why I'm making this video is that there's a hell of a lot of difference that you need to be aware of, which might influence what is best for you. This includes tax, accessibility, flexibility, choice, and packages, and even your own willpower. So let's start with a topic that I am not qualified to give advice on, which is tax. Do you like the subtle disclaimer? The key difference here is to highlight when tax comes into play, as both your pension and your investments could be liable to taxes. The way I think about it is that pensions are taxed afterwards, where investing your own money is mainly taxed beforehand. The beauty about pensions is that your money is going straight out of your salary into your pension. I always thought this meant that you avoided paying income tax, which is actually what happens, but the government refers to this as tax relief. This means the higher your income tax banding, so you pay 20% on everything over about £12,500, 40% on everything just over £50,000, and if you're slaying the cash, then you'll be paying 45% on anything over £150,000. So let's say you're earning £52,271, so £2,000 falls into the 40% tax banding. You could either put that £2,000 straight into your pension, or you could take it in your pay slip and receive about £1,200 of it. Obviously, the impact won't be as large if you're paying a lower rate of income tax. It's important to note that this tax relief is capped at £40,000 a year. So if you're investing over £40,000 a year into your pension, then after the £40,000 mark, you will not receive tax relief. Then poor rich people, hey? So it might make you think, would you rather invest £2,000 into your pension, or would you rather take the same £2,000, let it get whittled down to £1,200, and then invest into the stock market? Seems like a point for overpaying into your pension. But then do consider that once you draw down your pension, you're still liable to pay income tax. So if your pension is pretty chunky, then you could be paying 20, 40 or even 45% in terms of income tax on your pension. Do note though that your pension payments are likely to be lower than your normal income from your job, so your income tax is likely to be lower in retirement than it is now. If you decide to invest the money yourself, you're going to take the hit on income tax, But then if you're investing this money into a stocks and shares ISA, the money is then protected for life from any taxes. It could grow to any size and you wouldn't be liable to pay any tax on it as you draw it down as an income. So in summary, overpaying into your pension is no tax before and tax after. If you invest in yourself, it's tax before and no tax after, but as long as you've got it in a stocks and shares ISA. I'm going to give you a really crude example of the impact of this decision over a 20-year period. I obviously can't factor in all the little nuances, but I can give you a general steer. Let's say you could either invest £2,000 into your pension or £1,200 into the markets yourself. Let's say in each case they both grow at 7% a year for 20 years. The money in your pension would grow to over £8,000 and your own investment would have grown to only £4,800. Now let's assume that you pay 20% income tax on that additional money in your pension. I have picked a lower figure for your income tax as it's very likely that it'll be lower in retirement. So the £8,000 you've made from putting into your pension is now worth about £6,400. So it's still a whole £1,600 more than actually investing it yourself. That's 30%. So it's looking like a very convincing case for overpaying into your pension. And there's even an additional tax benefit that you might get at a later date, which I'll mention in a minute in this video. Before we look into the topic of accessibility, flexibility and willpower, I wanted to show you a bit of a magic trick. If you look below this video, you're going to see a greyed out, hideous, ugly grey thumbs up button. But with one simple click, you can turn it into a smurf. And if you don't know what a smurf is, then I have no words for you, I'm sorry. Anyway, smurf up, and thanks for supporting the video. So let's look at accessibility, flexibility and your own willpower when it comes to looking at overpaying into your pension or investing. There is one crucial difference between pension payments and investments. If you want your money back from your investments, it's truly easy. You just cash out your position and you've got the money in your hand and you can do whatever you want with it. But if you put it into a pension, it is locked away for a long time. Right now, the earliest you can touch your pension is 55. But the catch is that this actually moves to 57 in April 2028. So it must really suck if you turn 55 in May 2028. It actually used to be 50 all the way back in 2010. So before we get into the impact this might have on your choice, I want you to consider this. The pension age used to be 50, but over a period of 18 years, it's moved a further 7 years. It would be naive to think that you could live for another 30 years and for it not to move again. So I just wanted to throw a few numbers with you. Let's guess that the retirement age is going to move 2 years for every 10 years, which I think is more than reasonable based on history. So based on this thinking, let's just run through a scenario. Let's take myself for example. So I'm age 30, but in the year 2028, I'll turn 37. But when I turn 47, the pension age will move to 59. When I turn 57, it'll move to 61. But luckily, I would then hit 61 by the year 2052 before it moves again. And I'm obviously assuming that I haven't choked it by then. But if you're 6 years younger than me, and based on my prediction, you might have to wait till the grand old age of 63 to get access to your money. Just some food for thought. So the question is, when do you want to access this money? I have to say, this is by far the biggest turn off for me when it comes to pensions. Anything I put in now, I most likely won't be able to touch for another 31 years. 31 years. If I'm looking to invest money now to either retire early, buy a sports car, or take a less stressful job, then having this money locked up till 61 does not help me one bit. 61 is firstly not retiring early. Secondly, I'm not planning on having a bad back getting into my Ferrari. And lastly, I'm not looking to take a less stressful job when I'm 61. So in my mind, it's pretty useless. It's amazing how such a no-brainer 1 second in terms of tax benefits can be such a turn off the next. But then again, there are further tax benefits if you invest into your pension. Once you have reached your retirement age, you can take out 25% of your pension as a tax-free lump sum. So the money that's gone into your pension tax-free, you can actually get a large portion out of it tax-free also. The money being locked away for a long time does come with one benefit though. For the ones watching this, I'm going to take a bit of a stab in the dark and guess that you probably like investing. And due to this, then I imagine your willpower is probably higher than most. But if this isn't the case, then locking your money away instead of being tempted to spend it might be the way forward for you. On top of the fact that your money is locked away for a long time in your pension, I do have one further problem with them. You've got to think, when you join a business, it's not normal for you to have a lot of a say of where the money goes or what it does. It's all handed over to a pension provider. So that's a lot of your own money being invested by somebody else. So there's a little bit to say, have you really got much control over it? What are the costs, how it's performing, and all those sorts of things. You could of course opt to move your pension into a SIPP, which is a self-invested personal pension, where you can have more freedom to invest your money how you please. I'm not going to go through SIPPs right now, but if you're interested in a video on it, then let me know in the comments below and I might consider making one. So before I share what I do and what I plan to do, let me summarise my thoughts here. Overpaying into your pension comes with a lot of tax benefits, which means that you're likely to get a better return on your investments, with the caveat that both your pension and investments grow at the same rate. The biggest downside is a significant lack of flexibility, both in when you can take the benefit of your pension, but also what it's invested into, at least if it's not on a SIPP. Investing yourself has a harsh initial outlay in terms of income tax, but you can protect this once in a stocks and shares ISA, and from then on out, the world is your oyster, as they say. On top of this, you're free to invest it in whatever you wish, but that does come with the risk of you messing it up yourself versus a professional institution who've been doing this for a very, very long time, so you might consider that they're better managing the money than you are, but that is a very personal thought process. But as I always like to do, let me be transparent on what I do, with my lingering thoughts on what I might change in the future. I'm in the very fortunate position of being a 40% taxpayer, and I guess I'm in the unfortunate position of being a 40% taxpayer at the same time. Especially when you consider that I pay nearly another 10% on top of this in a student loan, so I'm getting hammered nearly 50% on the very top bit of my salary. Oosh. Because of this, the numbers are incredibly tempting to put additional money into my pension. So I currently significantly overpay into my pension for two reasons. One, my company pays up to 11% depending on how much I put in. I think I need to pay 6-7% of myself to get this benefit, so it's really, really tempting. And secondly, if I took the income, I'd be pretty much losing half it before I'd even started. So based on this, I contribute 9% of my salary towards my pension, and then I happily accept a further 11% from the company I work for. So currently there's a whopping 20% going into my pension. But after doing research for this script, it's actually really hit home how far 61 is from now. In a video that I released last week, titled My Investing Exit Plan, I'll put a ribbon in the top right, I highlighted that actually I was probably looking to retire around the age of 46. So does it really make sense that I'm doubling down on my pension when actually if I retire at 46 I then got to wait 15 years for this money? Does it really add up? So based on this, I think I'm going to investigate how much I can lower my contributions that go into my own pension without my own company lowering their end of the bargain either. Another thought that I've got is, why am I trusting somebody else to invest my own money? I feel competent and confident to invest it, as I already invest £60,000 myself, so why am I trusting somebody else doing it? And I'm embarrassed to say, I actually don't know how much they're charging me to actually run this pension for me, so I really need to look into it. As part of this, I'm actually going to investigate what the impact might be if I can actually move this investment over to a SIPP. On top of this, I actually have an AVC also, and if you don't know what an AVC is, then its full name is an additional voluntary contribution, which is basically when I got paid a bonus quite a while ago. I think I was 24, so nearly 6 years ago, and I decided weirdly to put it all into my pension, probably for the tax benefit. But then I can remember looking at it quite recently, and the growth of it absolutely stank, so it really didn't add up for me. But then saying that, I think it was invested mainly in the UK markets, which doesn't really mix with my philosophy, so I really need to look into it and try and do something about it. Anyway, I'm probably going to look into doing my own SIPP if I'm honest, but if you want me to do a video on it, then let me know. But on balance of everything in this video, I think realistically the best methods are the following. One is actually to have ensure that you have both, so make sure you have a decent pension, but actually make sure you've got your own investments also. Secondly, make sure you're maximising your company benefits. For me, that is a bit of a no-brainer. And thirdly, make sure you're aware of all the tax benefits, both through investing into a pension and also investing directly, so through an ISA. If you can do anything as a result of watching this video, then I think it is well worthwhile getting to know your pension much better. You have a lot of your own money at stake here, especially if you're an investor yourself. You could actually be working very hard right now investing your own £5,000 outside of work, but then you could have £30,000 being managed by somebody else with a very high cost, with a very horrible mix, so you really could do with getting closer to it. Anyway, that's all for this video. See you in the next one.